Liquidity is the foundation upon which the entire modern financial system rests. Yet, it remains one of the most misunderstood forces in global markets. Most investors think in terms of price, valuation, earnings, or macroeconomic trends. Professionals talk about growth forecasts, inflation expectations, and policy decisions. But beneath all of those narratives lies something more fundamental: the ability to transact efficiently without destabilizing the system itself. That ability is liquidity. Liquidity is not the same thing as money supply. It is not simply cash in circulation, nor is it the total wealth within an economy. Liquidity is the practical capacity to convert assets into cash quickly, in size, and at predictable prices. It is the difference between selling a position smoothly and triggering a cascade. As long as liquidity is abundant, markets feel orderly. Buyers and sellers meet with minimal friction, spreads remain tight, and even large transactions are absorbed without dramatic price dislocations. When liquidity is functioning properly, it is almost invisible. When it fails, it becomes the only thing that matters. In calm conditions, liquidity appears deep and resilient. Open any trading platform and you will see layers of bids and offers stacked across price levels. Institutional desks move billions of dollars worth of assets daily without obvious strain. Governments issue massive quantities of debt, and markets absorb it. Corporations refinance obligations routinely. Hedge funds deploy leverage confidently because funding markets appear stable. This apparent depth creates a powerful sense of permanence. Participants begin to assume that markets will always function this way. But that assumption is fragile. Liquidity is not guaranteed. It is conditional. It exists because participants are willing to take risk in exchange for compensation. Market makers quote continuous prices because spreads generate profit. Banks provide balance sheet capacity because capital ratios allow it. Repo lenders extend short-term funding because collateral appears safe. Hedge funds and high-frequency firms supply volume because volatility remains within modeled thresholds. Pension funds and asset managers rebalance portfolios because flows are stable and redemptions are manageable. The system operates because incentives are aligned during stable periods. When stability breaks, incentives shift rapidly. Liquidity is pro-cyclical by nature. It expands when markets rise and contracts when markets fall. Rising asset prices increase confidence. Increased confidence encourages leverage. Greater leverage increases position sizes. Larger positions deepen reliance on stable funding and narrow spreads. During expansions, liquidity and leverage reinforce each other, creating the appearance of robustness. Yet that same reinforcement amplifies fragility beneath the surface. The vulnerability emerges when an external shock disturbs equilibrium. The trigger can vary widely. An aggressive interest rate increase, a sovereign default, a banking crisis, a geopolitical escalation, or the sudden failure of a highly leveraged institution. The specific catalyst matters less than the mechanical chain reaction that follows. Volatility rises. Risk models adjust automatically. Value at risk constraints tighten. Dealers reduce exposure to preserve capital. Algorithms widen bid-ask spreads or withdraw entirely. balance sheet capacity shrinks precisely when it is most needed. As liquidity thins, price sensitivity increases. Transactions that would normally pass unnoticed begin to move markets materially. Large investors attempting to reduce exposure discover that executing size requires accepting worse prices. Price declines trigger margin requirements on leveraged positions. Margin calls force asset sales. Those sales exert additional downward pressure, which in turn triggers further margin calls. The dynamic becomes reflexive and self-reinforcing. Liquidity crises are therefore not primarily about declining valuations. They are about forced selling overwhelming available buyers. When multiple participants simultaneously seek to convert assets into cash, the supply of sellers exceeds the willingness of buyers to absorb risk. Prices gap lower, not because intrinsic value vanished overnight, but because balance sheet capacity vanished. History provides clear examples of this mechanism. During the 2008 financial crisis, structured credit markets froze. Institutions holding mortgage-backed securities found there were effectively no reliable bids. Counterparty trust deteriorated sharply. Interbank lending markets ceased because institutions questioned each other's solvency. Funding markets tightened dramatically. Even firms that were fundamentally solvent faced existential pressure. The problem was not exclusively credit risk. It was the evaporation of liquidity in core funding channels. A similar pattern emerged in March 2020. Global markets experienced one of the fastest liquidity contractions in modern history. As uncertainty surged, economic activity collapsed due to the pandemic shock. Investors rushed to raise cash. Even U.S. Treasury securities experienced severe dysfunction. Bid-ask spreads widened sharply. Dealers struggled to intermediate the surge in selling pressure. Yields moved abruptly, reflecting dislocation rather than fundamental reassessment. The Federal Reserve intervened with extraordinary asset purchases. The priority was liquidity stabilization. These episodes reveal an essential truth. Liquidity risk spreads faster than solvency risk. An institution can survive declining asset prices if markets remain functional and funding remains accessible. But if short-term financing dries up, even solvent entities can collapse under pressure. Modern finance relies heavily on continuous refinancing through repo markets and other short-term instruments. When lenders grow cautious and demand higher haircuts or withdraw entirely, borrowers must either post additional collateral or unwind positions. Unwinding positions in stressed markets accelerates price declines, which further increases collateral requirements. The system becomes a feedback loop. Contemporary market structure adds additional layers of fragility. Post-2008 regulations reduced banks' proprietary trading and balance sheet inventory, limiting their capacity to warehouse risk during periods of stress. While these reforms strengthened capital buffers, they also reduced the shock-absorbing role dealers historically played. At the same time, passive investment vehicles now account for a substantial share of equity ownership. When investors redeem shares from index funds, the funds must sell underlying holdings proportionally. This mechanical selling can intensify downward momentum across entire sectors simultaneously. High-frequency trading firms contribute a significant portion of intraday liquidity in many markets. Their algorithms function effectively in stable environments with predictable volatility distributions. However, when volatility exceeds modeled parameters, these firms reduce participation to manage risk. Because their liquidity provision is conditional, market depth can evaporate abruptly during stress. What appears deep in normal times can become shallow within minutes. Derivatives further complicate the picture. Clearinghouses centralize counterparty risk and demand variation margin as prices fluctuate. This structure enhances transparency and reduces bilateral credit risk, but it also institutionalizes margin calls. When volatility surges, clearinghouses increase collateral requirements to protect system integrity. Members must post additional funds immediately. Failure to do so can trigger forced liquidation. Thus, protective mechanisms designed to stabilize markets can accelerate liquidity demand during extreme volatility. The interconnectedness of global finance means that liquidity shocks rarely remain contained within a single asset class. Funding stress in bond markets can spill into equities. Currency volatility can affect emerging market debt. Derivative exposures can transmit shocks across borders rapidly. In severe episodes, correlations across traditionally diversified assets converge toward one. This undermines portfolio hedging strategies. Investors expecting diversification discover that systemic liquidity stress overwhelms asset-specific fundamentals. The most dangerous characteristic of liquidity crises is their nonlinear progression. There is often little visible warning. Markets may appear calm even as leverage accumulates quietly. Risk metrics remain subdued. Spreads stay compressed. Funding costs remain low. Participants extrapolate stability forward. Then, when a shock arrives, repricing occurs at a speed that overwhelms adjustment mechanisms. Liquidity does not fade gradually. It collapses in pockets, then cascades. Central banks recognize this vulnerability. Their crisis interventions frequently focus on restoring liquidity channels rather than directly supporting asset prices. By injecting reserves, expanding repo facilities, or purchasing securities outright, they attempt to re-anchor confidence. These measures aim to restart the transactional engine of the market. Without functioning liquidity, price signals lose meaning and capital allocation stalls. The structural challenge is that modern financial systems are built on leverage layered upon leverage. Sovereigns borrow heavily. Corporations refinance continuously. Hedge funds employ leverage to amplify returns. Derivative contracts create synthetic exposures many times larger than underlying assets. As long as liquidity is stable, this architecture appears sustainable. When liquidity contracts, leverage magnifies instability. Small price moves become destabilizing events because they propagate through margin frameworks and funding agreements. Liquidity, therefore, represents both the lubricant and the latent fault line of global markets. Its presence supports growth, efficiency, and capital formation. Its absence exposes systemic fragility. Investors often focus on valuation metrics, and macroeconomic indicators while underestimating the importance of funding conditions. Collateral quality and balance sheet capacity determine whether markets can absorb stress without spiraling. The day liquidity disappears is not merely a day of falling prices. It is a day when normal transactional assumptions break down. Bid-ask spreads widen beyond comfort. Execution becomes uncertain. Volatility feeds on itself. Risk management models, calibrated to historical distributions, struggle to adapt to regime shifts. Participants prioritize survival over return generation. Cash becomes the objective, not yield. Such events do not imply the permanent collapse of financial systems. Historically, liquidity has eventually been restored, often through decisive policy action. However, each episode leaves structural scars and prompts reassessment of underlying vulnerabilities. The question facing modern markets is not whether liquidity will face future stress. Cycles and shocks are inherent to complex systems. The more relevant question concerns scale and interconnectedness. With higher aggregate debt levels, greater derivative exposure, and increasingly automated trading infrastructure, the transmission speed of liquidity shocks may exceed that of previous eras. Understanding liquidity is therefore essential, not as an abstract academic exercise, but as a practical framework for interpreting market behavior under stress. It explains why fundamentally sound assets can experience violent drawdowns. It clarifies why central banks intervene aggressively during turmoil. It reveals how leverage, funding markets, and collateral frameworks intertwine. Above all, it highlights that market stability depends less on constant optimism and more on continuous transactional confidence. Liquidity is invisible when abundant. It becomes decisive when scarce. And in highly leveraged systems, its disappearance transforms volatility from manageable fluctuation into systemic threat. Welcome to Cash and Chronicles, where money, power, and history collide.